Do you think your taxes will be higher or lower in retirement? Most people assume they'll be paying fewer taxes in retirement. That's understandable because they're no longer earning a paycheck. Unfortunately, that won't be the case for many hardworking Canadians because the withdrawals from your RRSP, Canada Pension Plan, and old age security benefits and earnings from other investments are all taxed as ordinary income. And when you combine all of these income sources, you could be pushed into a higher tax bracket, forcing you to pay even more taxes in retirement than you expected. And that's not the only problem. Our national debt is at an all-time high. It's safe to assume the government could have no other option other than to raise taxes to pay down this debt. These are just a few of the reasons why knowing exactly what your tax liability will be in retirement is critical. Beware of these 3 retirement tax traps. Tax trap number 1. You probably know how much money you've saved in your RRSP, but do you know how much you'll owe in taxes on these accounts in retirement? Most people don't have a clue. When you withdraw money from your RRSP in retirement, it's taxed as ordinary income. The same is true for your Canada Pension Plan and old age security benefits and other types of investment income. It's all tossed into one big tax bucket. If most of your retirement savings is in your RRSP, you could have an even bigger tax problem on your hands. Not only will you have to take larger withdrawals to cover your expenses, but you'll also have to take out even more money to pay for the taxes on those withdrawals. Larger withdrawals means more taxable income. It creates a snowball effect that's really hard to stop. Here's the bottom line. How and when you withdraw money from your tax-deferred accounts could have a significant impact on how much you actually pay in taxes versus how much money stays in your pocket. Tax trap number 2. Between you and your employer, you've contributed to CPP every paycheck. Chances are you visited the CRA website and have a pretty good idea of what you can expect for your monthly Canada Pension Plan benefit at age 60 or 65, depending when you apply for the benefit. Most people are shocked to learn that they have to pay taxes on their CPP. When you turn 65, you'll be eligible for the old age security. However, there are income thresholds for collecting your old age security benefits and could be clawed back if you make too much money. Here's an example. If your retirement income is more than $90,997, then you'll have to repay 15% of the excess over this amount to a maximum of the total amount of the OAS received. What that means is 15 cents of every dollar that you earn that exceeds $90,997 in 2024 will be clawed back. The threshold where your entire benefit is clawed back is $148,065 for retirees aged 65 to 74 and $153,771 for people aged 75 and up. You can avoid the OAS clawback by splitting pension income. When one spouse has taxable income exceeding the clawback threshold, they may be able to reduce or eliminate the clawback if their spouse has a lower marginal tax rate. Through pension income splitting, they can allocate up to 50% of their eligible pension income to their lower income spouse. That's good news. Tax trap number 3, not preparing for higher future taxes. A big problem has been brewing in Ottawa over the last few years. The government has gone on a massive spending spree that caused our national debt to skyrocket. Increasing taxes just on the wealthy Canadians won't be enough to climb out of our national debt. When higher taxes do hit, you could easily see tax increases on your RSP, capital gains, which we've already seen, and corporate taxes, which are almost always passed on to you and I as the consumer. This is why more and more Canadians are proactively taking steps to auto-approve their hard-earned savings. You may not realize it, but you have more control over how much you pay in taxes when you're retired than at any other time in your life. But this doesn't happen automatically. You must take advantage of tax planning. Most Canadians do what they've always done. They simply prepare and file their taxes every April with the help of an accountant or CPA. But aside from some obvious deductions that might save a few bucks, at this point, what's done is done. Tax planning is completely different. Here, you're looking forward, not backwards. And the savings are often significant. It's not uncommon for us to uncover as much as $100,000 or more in tax savings. You may be thinking, Isn't tax planning just for the wealthy? It's a common misconception. Many of the same strategies the wealthy use to save on taxes are also available to you. You're probably just not aware of them. That's why we created the Banker's Secret Retirement Tax Savings Analysis. Once we get some basic information from you, we determine the tax planning strategies that are best suited for your specific situation. Most advisors charge thousands of dollars for an analysis like this, but we will do all the heavy lifting for you and it won't cost you a dime. The strategies we use are best suited for families who have saved at least $200,000. To schedule your free analysis, go to McGuireFinancial.ca or call 877-364-8204. While you're here, take a moment and click the thumbs up button. It really helps us out. And if you haven't already, go ahead and subscribe. We'd love to keep you posted.